Hi there. Do you know how to compute free cash flow? My name is Steve Coffrin. I'm the founder of Boosting Your Financial IQ. And in this episode, I'm going to walk you through the mechanics of computing this very important component of finance, free cash flow. So let's get started and jump right in. All right, let's jump into this very important topic. Free cash flow is the lifeblood of every single company out there. So you have to know how to compute this, and you have to understand how to compute it correctly, because there are some nuances when it comes to levered and unlevered free cash flow, which we're going to get into in this episode. So let's jump in. Before we get going, just know that this is for educational purposes. You can learn more about our privacy policy and our terms of use at byfiq.com. All right, so what is free cash flow? Have you heard of this term? Because this is super critical. And this is why the statement of cash flows is so important and one of the most important financial statements out of all the three financial statements. So today, I'm going to explain what it is, how to compute it, and the difference between levered and unlevered free cash flow. What is free cash flow? It's simply the amount of cash that's available to capital providers. Now, you may be wondering, what the heck is a capital provider? Well, let me tell you. There are two different types of capital providers for most companies. So if a company has any kind of debt, there are debt providers. These are banks or other institutions or individuals who lend money to the company. So these are the creditors of the business. They've extended some type of debt instrument, and the company has to pay them back. So there's debt providers, and then there's equity providers. Now, maybe your company is a small business and you're the only equity provider. You're the one who's put all the cash into the business. Well, guess what? You are the equity provider. So it's the amount of cash that comes home to you. But if you have investors in your business, these are the equity holders of the business. So if you're a publicly traded company, these are the stockholders within your organization. All right, so those are the two different types of capital providers, debt and equity. Debt providers, they require interest payments on the debt that they extend to the company. And equity providers, they're going to want to see a dividend or distribution, depending on what type of structure you have. A dividend for corporations, distributions for LLCs. But nonetheless, those are the two different types of capital providers, and companies generate free cash flow in order to satisfy the demands of creditors or debt providers, or to provide a return to equity holders and those who have invested within the company. So why is free cash flow so important? I just explained that it's the amount of cash available to debt holders and equity holders, but it's also a critical component when it comes to valuing a business. So if you think about it, if you want to determine what is the price, okay, what is the valuation of a business or a price of a stock, the way you're going to compute that is by taking the sum of all the cash flows of the business. So years 1 through 10, the company is going to produce cash. Hopefully each year, the amount of cash that it's producing continues to grow as the top line grows and as the company realizes efficiencies with its costs, and it drives greater profitability. So the company creates all this cash over the life of the business, whether it's 1 year, 5 years, 10 years, into infinity, right? There's no business that lasts into infinity, but you know what I mean? It goes into perpetuity, I guess I should say. If you take the sum of all these cash flows here, this is how you determine the valuation of a business. All right. So when you're doing strategy work, I talk a lot about how value exists at the intersection of strategy and finance. When you're doing strategy work and you're trying to determine what initiatives to pursue within your company, you want to pursue initiatives that drive greater cash flow. It's not just about profit within a company, because as you'll see, there are a lot of things below profit that impact cash flow. 70% of companies that go bankrupt are profitable when they close their doors. We care more about cash because we want to know how much is available to debt holders and equity providers, as mentioned before. Okay, so intrinsic value of a company and the valuation of a business. Real quick, I'm not going to get into this in a lot of detail. I have other courses and videos that you can explore if you want to learn more about this. But in the context of free cash flow, Warren Buffett said, intrinsic value is this important concept that offers the only logical approach to evaluating the attractiveness of an investment and an overall business. So intrinsic value is simply, it's the discounted value, so the value in today's dollars of the cash that could be taken out of a business during its remaining life. That's free cash flow. That's why it's so important, because it determines valuation, but it also determines at the end of the period how much is available to pay off debt and to create a return so investors stay interested, engaged in the business, and the company continues to acquire the capital that they need in order to grow. Okay, there are two types of free cash flow that you should be aware of. First is unlevered free cash flow, and I'm going to give you an example of how that breaks down, but essentially, unlevered free cash flow ignores the capital structure of a business. Remember, the capital structure of a business includes both debt and equity. So when you're computing unlevered free cash flow, you ignore how much debt and equity the business has because you want to determine free cash flow separately for this. Now you may say, Steve, well, why the heck would I want to do that? Because if you're looking at doing a leveraged buyout, like private equity firms, they're going to compute unlevered free cash flow because they may have their own capital structure. They may come in and provide different levels of debt or equity, and the capital structure may change. So they want to be capital structure agnostic. Okay, so they ignore what the existing capital structure of the business looks like because that may change based on an acquisition, a deal, a restructuring of a business. That's why you would use unlevered free cash flow. So it ignores the capital structure, debt, and equity. And associated with those two things are interest expense, which is debt, and interest income, which is cash. So you're going to ignore those items. Levered free cash flow includes interest expense and interest income. It accounts for the current capital structure of the business. That's the primary difference between unlevered and levered free cash flow. Like I said, this episode is just strictly focused on free cash flow, but I wanted to point out the differences and the nuances between these two things, because if you just look this up on the internet or you watch other YouTube videos, it's just going to tell you generically how to compute free cash flow, and you want to make sure that you're doing it correctly based on the analysis and the result that you're trying to find. All right, so let me give you an example of unlevered free cash flow and how you would determine that. So first, you take the revenue of a business. So you have revenue, you have cost of revenue, also known as cost of goods sold. So you take these two things, you net them out, and you end up with gross margin. This is the profitability of the business after accounting for the cost associated with delivering the products and services. So you have the revenue, you sell a product or service, you deliver that product or service to the end user. There's costs involved like labor costs, there's direct material, other direct costs. Take those out, you end up with gross margin. Then you're going to subtract out your overhead costs, your fixed costs, also known as G&A expenses, general and administrative expenses, or operating expenses. You end up with EBITDA, earnings before interest, tax, depreciation, and amortization. And since we're trying to compute free cash flow, but we want to account for taxes, we're going to deduct out depreciation and amortization. Now, depreciation and amortization, this is an expense associated with tangible and intangible assets that the company has purchased that they're amortizing or depreciating over a period of time. So remember, if you buy a piece of equipment for $50,000, you can't just expense the whole thing on your books in a accrual accounting manner in 1 year. You have to spread it out over its useful lifetime. So you buy a machine for $50,000, it's going to last 5 years. Each year you can record $10,000 of depreciation expense for tax purposes. Now there's different nuances when it comes to taxes. There's Section 179, there's makers. There are other methods for computing depreciation and amortization. That's why in an unlevered free cash flow analysis, you are ignoring the capital structure because maybe the company has a different way of accounting for depreciation and amortization, and you want to just make it apples to apples across companies. So when you're doing comparables and you're really trying to fine tune your analysis, or you're trying to model out different scenarios for the capital structure, you're going to want to ignore all that. But anyways, you take EBITDA, take out depreciation and amortization, you end up with EBIT, EBIT, just see how we dropped the DA, depreciation and amortization. Then that's our earnings before interest and tax. If you notice there, the I in EBIT is excluded because remember, in an unlevered approach, you're ignoring interest expense, interest income. All right, so you take out taxes, you end up with net operating profit after tax. You add back depreciation and amortization because remember, we're trying to get to free cash flow. And depreciation and amortization expense is not a true cash expense. You're not actually writing a check to a vendor called depreciation and amortization, right? It's just an accounting treatment. So we're adding it back. It's a non-cash activity. Then we have to account for changes in net working capital, which is primarily your changes in accounts receivable and accounts payable. So your customers owe you money, you owe your vendors money. There's other assets, other current liabilities, but the delta between these two, your current assets, current liabilities, that's your working capital. You're going to want to account for these changes period over period because this really impacts cash. If your customers owe you money, you're going to have less cash because it's recorded in revenue and it's accounted for in your profitability, but you don't have the cash because it's on account. Same thing with your vendors. If you are paying your vendors, you're going to have less cash. So that's what I mean by these changes in working capital. You have to account for that. You can learn more about this in more detail in another episode that I'll drop. Then you account for capital expenditures. These are investments in property, plant, and equipment. So if a company is investing in machinery or equipment, this isn't accounted for up above in EBIT or EBITDA. Depreciation and amortization is accounted for, but not the actual investment in the equipment. So you have to take out those cash outflows. And then you end up with free cash flow. So this is how you compute unlevered free cash flow. Just remember, it ignores the capital structure. And that's why you're not accounting for interest expense, or interest income. All right, that's probably a lot. Hopefully you're still with me and you're not like, holy cow, I'm about to click off this video. It is kind of a lot at first, but once you put this in an Excel model, it's all going to start to make sense. So stick with me. Let me explain how to compute levered free cash flow. And then you're going to be all set. You're going to be an expert in determining free cash flow. All right, so you may be wondering, where do you get all this information? I'm going to show you here when I compute levered free cash flow. But all these items up above come from the income statement. And all these items down below you can find on the balance sheet. So this is how the three core financial statements, the income statement, balance sheet, and statement of cash flows, this is how these three things work together. If you want to learn how to read an income statement, balance sheet, or statement of cash flows, I have separate videos for that. Make sure you check those out so you can boost your financial IQ in this area. All right, so now let's move on to computing levered free cash flow. And then you're going to be an expert with all of this. So stay with me. We're almost done. Let's jump in to Chipotle. So I'm going to show you in real life how to compute free cash flow off the financial statements. Okay, so now we are looking at Chipotle's financial statements. I pulled these off the SEC's website. You could do the same thing, but this is essentially their 10K annual report. When you're a publicly traded company, you have to file an annual report. It's called a 10K, and this is what we're looking at here. Remember, like I said, if you need to deepen your knowledge about how to read the income statement, balance sheet, or statement of cash flows, make sure you check out my other videos specifically on those financial statements. Okay, so stick with me. Here's the last piece. We're going to compute levered free cash flow, which essentially includes and accounts for the company's capital structure. So we're going to include interest expense and interest income in this calculation. So to compute free cash flow, all you need to do is go to the statement of cash flows. And we're going to start with down here, this net cash provided by operating activities. So we have right here, net cash from operating activities. And that's going to equal this amount right here. Okay, and I'll do it for each year. Bam. And then I'll do it for 2019. Okay, so this is 2021, 2020, and 2019. Bold, Alt HBU, do a little shortcut. Bam, little formatting. Okay. And then let me create a little space. Okay, so then we have net cash from operating activities. This accounts for net income. Okay, net income already has tax taken out. Then we add back depreciation up here already. So it's similar to the unlevered cash flow calculation. You have depreciation, amortization, and all these other items that are non-cash posting. And then you have these changes in current assets and current liabilities. These are the operating current assets and current liabilities of the business. And you'll see the ups and downs, the inflows, the outflows of each of these line items that are coming over from the changes on the balance sheet period to period. And ultimately, you end up with cash from operating activities. But there's one thing we have to deduct that we accounted for in unlevered free cash flow. Can you guess what that is? All right, if you said capital expenditures, you are correct. If you said CapEx, that's the cool way to say it, CapEx, right? Short for capital expenditures. We have to account for that, and we're going to deduct that out of our operating cash. So if I just come here, and it's this line item right here, purchases of leasehold improvements, property, and equipment. So this is Chipotle buying grills and refrigerators and other types of equipment for their operations to make those delicious burritos and tacos and bowls and everything else that hopefully you enjoy, because I love them as well. Okay, so we're going to sum these up. Alt HBH. If you know the shortcuts, it makes you so much more proficient in Excel. I just did the shortcut Alt HBT, which when you hit Alt, it pops at these. I hit H, it pops up here, and it pops my borders. And then I could put a quick border on this. See, check that out. Alt HBN is no border. Alt HBT is a thick border. Just a little side note here. Free cash flow. Bam. And let me label this so you're not confused. This is levered free cash flow. And what does that include? Yeah, it includes interest income, interest expense. This is the free cash flow of Chipotle. As you can see, it's pretty simple. You can do this. You don't have to be this expert accountant. All you need to do is learn how to go to the statement of cash flows, pull up operating cash, deduct out your CapEx, and then bam, you got free cash flow. So it's a much more direct way of finding free cash flow compared to unlevered, but unlevered's not that complicated either. I just walked you through that. So hopefully that helped. And now you feel so much more confident when it comes to computing free cash flow on your own. If you want to learn more about reading financial statements, financial modeling, if you want to access great tools, if you want to speak the language of money and feel more confident with numbers, go to byfiq.com. There's tons of resources for you, and a lot of them are free. So you could check out the podcast. The podcast is a great way to boost your financial IQ when you're on the go. There are videos and other tools if you sign up for the community, which is free. Okay, just sign up for free. There's also programs and courses that will help you to deepen your financial acumen and to build the skills that you need to live a better financial life. So go to byfiq.com. And if you don't follow me on the social channels, go to your favorite ones, check me out. There are a lot of great resources there as well. And there are even little micro lessons that you could tap into to learn something new every single day. And that's what it's about, is taking this journey and boosting your financial IQ one day at a time so you can live a better financial life. Hey there, I hope you got value out of this episode. I hope you feel more confident and comfortable when it comes to computing and interpreting free cash flow and all the wonderful benefits that come from it. Make sure you check out the other videos where I walk through how to build a discounted cash flow model, the difference between levered and unlevered DCF models, all of these things related to free cash flow. Free cash flow is the lifeblood of a business and the determining factor of intrinsic value. So if you got value out of today's episode, it would mean the world to me if you hit that like button. Also remember to leave your comments below. I love your feedback. If you are already a member of the Boosting Your Financial IQ community, thanks for joining me. Your support means the world. If not, go to byfiq.com where you can sign up for free and become a member and access great resources there on the website. Make sure you subscribe to this channel so you're notified of new videos every time they drop. And in the meantime, keep on rocking it and take care.